Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, when we want to take this and look at this farther, I mentioned trend development and some additional support and resistance levels. And these are really other building blocks that you can incorporate into establishing your target levels that's going to help give you a better chance for really making that successful target placement. So with trend development, here's an example from the last class I taught where we were looking at the dollar-yen, which is the YUK when we're looking at the options. And we're seeing, of course, another example of this momentum shift here. I'm going to change my tool so we can see this a little bit better. So we've got a momentum shift forming. Again, a strong breakdown. This happens to be a very strong move. It's not substantially stronger than average in the past moves. Here's a V bottom for us to look at and kind of compare. And so it's about an average pace move. And we have a little bit of a two-wave correction here marked as A. And a good example of where we had nearly an exact equal move for the continuation of this. And this followed through again with another two-wave correction on B and a third break lower. And if you look at A and B, the really important thing to see here is that each of these corrections is approximately the same amount of time. They're each lasting for the same number of bars, usually within 1 or 2 bars. And that is very important for helping you assess whether or not that trend is exhausted and more likely to give you a larger correction, or if it can keep going and give you an even larger reward on a larger time frame. In this case, because each of these was equal, it gave the higher chance that we would see this channel break from this downtrend. And you can see that as it came back up into that channel resistance right here, it really didn't stall at it at all. It touched it, paused a little bit, and broke right through it. And that's a very, very common type of action. You can see that in a little bit of the template that I have down there in the lower right-hand corner. So we are going back and looking at that previous example of the CDD. And I mentioned that in addition to trend placement or trends development, another tool that can help you out when you're looking at whether or not you're going to see a move stall short, falling short of a target level or able to push through the target level, is to look at where there's additional levels of support or resistance. So things like gap closures, things like previous highs, previous lows, even prior congestion zones where, let's say we have a lot of back and forth action and the security breaks higher and pulls back and forms, looks like a continuation move. If there's a lot of congestion here, there's a higher chance that this continuation is going to end up being a more gradual move. And it's not really going to break through that congestion very easily, especially if this stalls here before it comes into the midway level of that congestion. So there's a higher chance that this continuation, I'll just mark it A here, ends up giving you less than that equal move. And it could actually be a two-wave correction that leads to another move on the upside. So this is another type of support level, looking at congestion zones. This here would be an example of a congestion zone. This would be an example of a congestion zone. So a retest of that zone would serve as a resistance level if it came back into that zone. Now here's a previous high, and we're also dealing with a type of gap closure here. And notice that even though the equal move target is down here, the slowing momentum helped combine with this previous high that it held that level almost exactly. And this is something that you can start to identify before you even go into the position. A typical continuation pattern is a two-wave continuation. So it triggers in here as a short setup. So if you look and you place your target level based on the equal move down in here, you also want to see, is there any major support zone that could possibly stall it before it hits that level? And that level, of course, is that previous high. So that then gives you a larger target zone of in here to shoot for. Here's, I told you, I was giving that class in New York last week, and I touched briefly upon the concept of these equal moves. I was looking a lot more in terms of larger time frames, looking out, several months, several weeks or such. But when I was doing scanning ahead of the class, one of the things that really popped out was that a lot of the currency pairs were showing levels where they were coming in and hitting these equal move support and resistance levels. Now, this one we're not looking at an option. We're looking at the pound yen, which is just straight out of the spot market here. But the same concept is going to apply to options. It's going to apply to whether you are trading the ETFs, and it's going to apply whether you're trading the futures. It really doesn't matter which one you're sticking to. So if you're trading the ETFs, you're going to see these equal moves happen quite a bit as well. And, Steve and the ISE, they're also starting to give a lot of webinars on the ETFs. So be sure to check out the schedule for those upcoming in the next couple of weeks as well. And I'll probably be doing a class on those sometime in April. We haven't quite set down the exact date for it yet, but keep an eye out for that. So it'll be another free class that you guys can stop by and participate in. So here's this pound yen that I was looking at on that Monday, and of course some of the market was closed on that Monday, but we saw the Forex market was still open. There wasn't really much happening at that time on that day, but what we had seen was an initial rally off of the lows at the start of the year. Let me switch this back to a different color. So here was our initial rally. And then there was a period of congestion here and the continuation move. And what I was looking at was we were having this continuation move, but the momentum was less than the initial upside move. So we'll call that initial upside move A and the continuation B. So the momentum on that continuation was slower than the momentum of A on our initial push higher. And this is where you can use the same concept of momentum and equal move targets to also help establish positions that go in the opposite direction, that are corrective moves or reversal moves. So if you have, say, that equal move target hitting, you can use that as a guide for establishing a move in the opposite direction. If that equal move target was a high target, then you can use it to look for reversal strategies coming off of that resistance level. And again, combine it with other things, such as here we had a previous high that was hitting back in here, which is another type of course, really strong resistance. This was a V bottom too as well. Let me clear this so you can see what I'm talking about. And a lot of times when you've got a V bottom and the overall momentum of each of these moves is very similar, it's very difficult for it to break past that previous high to any real degree. Typically what is going to happen is that it's going to stall short of that level, slightly higher than that level, but it's going to pull back and lead to a longer trading range, particularly if this low was lower than the prior low. So we're looking at that happening right here where we had this second low here that was high, that was lower than the first low back here in A. And so this level, based upon the pace or the momentum, really helped establish that as a resistance zone. And when we come and look at this again, notice that even with this, within this initial upside move here, there was an equal move as well. But the momentum was similar. They were comparable moves where the first rally into this 20-period moving average had the same momentum on the continuation. And that also came into a previous high where the overall pattern was a V bottom, which suggested that it would have a very difficult time breaking through this high here when it retested here. And that actually led to this correction that we saw take place heading into February. Now, on this, of course, this established a short setup that triggered early on Tuesday and really followed through well. And we're seeing how earlier I mentioned that congestion levels will serve as a price target. So a couple days ago, I gave the target level here as it was hitting right into these moving averages as well as this congestion level. So we're not only seeing these equal moves form in terms of establishing targets on the upside, but we're also seeing them as tools that you can use to help position yourself on corrective moves. And since this continuation pattern was a slower move than the initial rally, it made it easier for this to follow through more quickly. If it had actually bounced and had like a sharp continuation on the upside like this compared to this, you would have seen, in order for it to have fallen quickly, it would have needed to have rounded off at the highs, given a stronger momentum move that way, or it could have easily fallen into a longer congestion or a longer trading range. Maybe if that range had based here like this, it could have broken lower. But it's not going to reverse rapidly off of that equal move level. So the slower it hits, the faster the correction is typically going to be. The faster it hits, the slower the correction is going to be. So those are some things to look for that hopefully they can help you time not only what you're looking at for target levels, but also for helping look at reversal patterns and corrective type of moves as well. As Steve mentioned earlier when we just got started, I have a number of courses that I put together over the years that really go into my style of market analysis. They go into a lot of these building blocks, and I put together a special that is actually running as part of the expo. And it gives you a really large discount on the courses for a short period of time here. One of them that I would really recommend for option traders is this market timing guide. And basically what it is it goes through a lot of strategies. A lot of them you've probably heard of, things like breakouts, bull flags, that sort of thing. But it goes into them in a non-traditionalist type of way. So instead of saying, a bull flag is a pullback into a support level like this in an uptrend, here, this be a bull flag, it helps you look at what's actually going on within this flag itself to give you an idea of where to place your target levels, whether it's actually going to have a high chance of success or if it's going to be a bull flag that actually fails. So it goes through each of those 5 building blocks in detail with each of the patterns, and there's dozens of patterns that it covers within this course. A lot of my favorite ones, such as momentum reversals, continuation patterns. So if you're interested, this is one of the lowest prices we've ever had on this course, and I would encourage you to check it out. I'm going to go ahead and take questions here. I'm sure you guys have a lot of them. You usually do, and usually I run out of time to answer them all. So let's go and look at some of these here. Let's see here. I'm going to scroll up. If you have any questions at all, please feel free to go ahead and post them in chat. And also, I believe that Steve gets copies of questions that are posted directly to them as well. So I will look at those as well.
Toni, you're seeing them, right? Questions?
Yes. I have. My window is very small here, so I'm going to go through and look at it. Okay. Rob says, thank you for the beautiful presentation. What you're saying sounds and looks very powerful, but when you're trading live against the right edge, how do you determine when the second leg begins? I mean, it looks great in hindsight, but is there a way to know that the second leg is starting, or at least that the correction is over? That's a really good question. Actually, when I'm working with clients, a lot of times what I have them do is, even when they're looking back, let me actually scroll back to some of these charts here. Even when they're studying and looking at things, after the fact, I encourage them to go back and basically cover up everything that happens in the future and go and look at them bar by bar as they unfold, as they develop. There's a lot of things that you're going to notice that really do give you that heads up. And when I gave this as a short last week at that presentation in New York, none of this had happened yet. We hadn't seen the trigger. We hadn't seen any of the follow-through. So we really were looking at that hard right edge there. And interestingly that you use that term, because my daily columns posted on Alan Farley's hard right edge, which is his website. But so that's one way of really kind of starting to get the feel for it. When you see like a pattern follow through, go back and watch it unfold bar by bar, step by step. With the building blocks that I use, that's the main tool that I use for how to determine when a strategy is ready. So, for example, back here, we have 3 legs of upside. This tells me to be on the alert that a larger correction is likely to occur where this channel break happens. And so as this is hitting this point in here, when I see that develop, I'm already starting to watch for reversal patterns. And you have to drop down and use multiple time frames. That's a really important thing that a lot of people sometimes overlook. They'll trade off of like a daily chart, but they might not pay as much attention to the fact that even when you're trading on a daily chart for like swing trades like this was, you really want to look at the 15-minute, the 30-minute, and sometimes even a 5-minute chart to help identify smaller patterns. In this case, there was a momentum shift here at highs as well, because this third high, it hit that equal move, but it did so with such strong momentum that if you remember earlier, I said that a stronger momentum move, you're going to get either a trading range and a longer base, or you're going to see the momentum shift before it's able to turn back over. And that's what we saw here, is we saw that shift and turn back over. So you don't want to go and just take a reversal right as it hits that equal move level if it's going to be a stronger than average move, because you have a chance of it's either going to fall into a trading range. You might get, of course, a little bit of price pullback, or it's going to put in slightly higher highs, which essentially would end up trapping or stopping you out with each of those slightly higher highs. So you want to wait for the confirmation, such as this channel break here with that 10-period moving average, to give you an entry trigger for the setup. And again, there's a lot of things. When you're looking at the building blocks, it's really a matter of putting them all together. That's what the market timing guide does, is it looks at each building block, not just in and of itself within a price pattern, but how they work together. Pace and momentum, as well as trend placement, are 2 of the most powerful things that you can look at in terms of determining what the upcoming price action is going to be. Now, when you're looking at the hard right edge and you're looking at things like equal moves and measured moves, it can be very, very simple to determine where you're likely to see that correction, because if you see an upside move of 4 bars, a correction move, and then the breakout, you're going to be looking for about 4 bars as long as the momentum is comparable. And that's going to tell you, okay, here's where I want to then start to look for a correction or a reversal. Another example of something that you can use, again, this is not something that I have much time to go into here, but on these bases, let's say we're looking at a breakdown. If this initial move to the downside lasted 5 bars, you want a base or correction that's going to last about 1.5 to 2 times that amount. So let's say this breakdown is 5 bars, and this correction is 10 bars. That's where you're going to want to start to look to position yourself on the downside. start to give you a heads up that, okay, this is getting ready to trigger now. And you can drop down to the smaller time frames and look for those setups on, say, let's say this is a daily chart. You can drop down and look for them on the 5 and the 15-minute time frame now once you have hit sort of that key zone. Now, if this is a faster, substantially faster than average drop here, this base can last much longer. So that can be an exception to that rule. But when you're just generally dealing with typical continuation moves, that's kind of the sort of ratio that I use. I use 1 to 1.5 to 2. So that's what you want to see on this congestion versus this initial level here to help time that breakdown. So yeah, there's definitely a lot of things that you can use that will help you give that heads up and that confidence to take a position. Honestly, a lot of my positions that I take, I end up taking before you even have solid triggers like this channel breakdown here, because I've combined those building blocks together in such a way that I know that it has to go at this point. And usually if I'm wrong, I end up mostly scratching them. So that's really, I think, probably the best answer that I can give you on that. But there's so many different things to look at that it's really another class in and of itself. Another question here is, to be able to review these, ISE, like I said, does have archives, and you'll also be sent a video archive of this. So you can go ahead and review it that way. If you have any other questions, you can email me. The best email to reach me at, I'll put it up here, info@tradingfrommainstreet.com. So Trading from Main Street, all spelled out, tradingfrommainstreet.com is the best way of reaching me.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.